Certified Kingdom Advisor Mark Trice, and joined by my fellow financial professional, Jesse Hamilton.
Hey, everybody, good morning.
We are doing our monthly market update for July now. I know this is a week later than we normally do it, but with July 4th last weekend and most people out of pocket, we decided to just postpone that until this week. So we hope that you had a wonderful 4th of July weekend, that you're healthy and things, but we want to try to talk to clients and also people that aren't clients with us yet, talk about what's going on in the markets, what things do we see developing in the near future in the next few weeks and months, and what are some things that you can do with your own investments and portfolio if you're not working with us to help you navigate these really uncertain times. And so with that, I'm going to go ahead and kick it off and hand it over to Jesse. Jesse, why don't you go ahead and give us the market update. We're going to be talking about the performances of the market indexes in June. And there you go, Jesse.
Yeah, so let's get started by just talking about some of the main indexes in the stock market and their performance through the month of June. Oh, we lost the screen share there, Mark.
Sorry about that. That was my fault. Is it back?
Yeah, it's back.
Okay.
So the screenshot right here is a little bit of a screen capture of the 30 trading days, I believe it was, in the month of June. And you can see we had quite a drop off there the second week, but that performance was minus 8.39 for the month. And that was a part of a greater 24.52 drawdown from the peak on January 4th through June 17th. And that is very comfortably into a bear market territory. We generally consider a bear market to be minus 20% or more. And I guess I should have started it off by saying that the S&P 500 is a basket of the 500 largest stocks in the United States. So it's a very common measure that we use to determine the performance and health and conditions of the overall market. So let's move on to the NASDAQ.
Hang on just a second, Jesse, before we go to the next slide. I had myself muted and I was trying to talk. Oh. But, you know, many of you probably read the headlines at the end of the week, right before July 4th weekend. S&P 500 has its worst 6-month start since 1970. Yeah. Worst 6-month start since 1970. And many of you that are listening to this you were probably still in high school, maybe a young adult at the oldest, and I was not even a figment of my parents' imagination. And so, and we know Jesse wasn't here, but that's a long time. That's the worst 6-month start to the S&P 500 since 1970. So to give you some idea, we were in the middle of the Vietnam War, and that was building up. Yes. And Nixon was in office. And so a lot of stuff is going on, and a lot of things have changed since then, but a lot has stayed the same. And we're going to get into that a little bit later on. All right, Jesse, let me go ahead.
Mark, really quick before we move on, there's kind of an interesting chart pattern. You know, as technical analysts, we look at the chart to determine what's going on. But if you see the first 7 days of the month, you could draw a line straight through the price. And it doesn't really change much. And we were waiting for it to either draw up or draw down. And we know that every day that it continues to go sideways like that, we know that something's probably going to come. We don't know which direction it's going to go. We could never tell you which way it's going to go. But
yeah, that level of consolidation, is okay. And we usually know it's going to break one way or the other. And in this case, you know, the month of May ended up on an uptick. And, you know, energy was still doing well during that time, and things were beginning to build. And then we had this sideways, we call it consolidation. It's where the market starts to build, a back build, if you will. And depending on the economic data that comes out or whatever reasons demand may be affected, prices started dropping in early June. In fact, energy, and Jesse, we'll look this up in a minute after your segment's done, but in a few minutes we'll see how much energy has dropped since its peak um, in June early. But that was about the only sector in our economy that was positive for the year, was energy, the energy
Mhm.
sector. And it's still positive for the year, but it's given a lot of the gains back that we had earned early on. But this type of consolidation, then a big drop off, is a concern. Later in the presentation today, I'm going to go through what we talk about with bear market rallies. Because we are in a
Yeah.
bear market, and a lot of times we'll have periods of rallies and only have the market to continue on down. And we don't know that this is one of those rallies, but we'll talk about that a little bit later on. Okay,
Mhm.
so Jess, let me advance the slide for you.
Okay.
All right.
So next, we're going to talk about the NASDAQ Composite Index, which is a group of technology-focused stocks in the market. These are varying from large cap to the mega cap companies that we all know about and use every day. They tend to use a lot of leverage and move pretty quickly, but that index was down 8.71% during the trading days of June. And this is a part of a greater 34.83% drawdown. That peak of this index was on November 22nd of last year. And then we had a trough on June 17th there. You can kind of see the bottom of this chart picture. That was June 17th, and a new low from the drawdown in November.
So something that's interesting about the NASDAQ, Jesse, and all the tech companies is tech companies usually underperform in a rising interest rate environment. So all the tech darlings that we had coming out of the pandemic, I'm not supposed to mention names and things because our compliance department considers it an endorsement, but you know who they are, and they're the big ones. The FANG stocks there's actually an index for the FANG stocks. That's the Facebook, Amazon, Microsoft, Google, Netflix are on there. So during periods of rising interest rate environment, that's generally not good for tech companies because of the way that they manage their earnings and so forth. And we can get in that sometime if anyone has a question about that. But the NASDAQ has been hurt the worst this year by a declining economy, rising interest rates, and rising inflation. So we've seen that really taking a big hit this year. And so, check your portfolios, make sure you're not overweighted too much in tech right now. All right,
Yes.
Jesse.
Thanks, Mark. Yeah, let's move on to small caps. So this is a different type of company that tends to be a little bit smaller, and generally these companies are, $100 million market cap type size, but you probably have some in your 401k, right, Mark?
Yeah, most 401k plans have this as an option. They might be in certain types of mutual funds. You want to check and make sure that you understand the holdings in your mutual funds and your 401k to just so you understand what's there. And we're not making recommendations and making any changes to your 401k. Just you want to know and educate yourself about what you own.
Yeah, I only say that because some people actually are holding these different stocks and they don't know about it. But anyways, the Russell 2000 is an index that we use to follow small caps, and that was down 8.61% in the month of June. And that's a part of a greater story of 33.41%. Yeah, that goes back to November 8th, actually, Mark, through June 16th.
Okay, all right. Yeah, so it's been declining for a while. Okay,
Yeah, so we can move on then.
all right.
Let's talk about the safety of bonds really quick. Um, the long-term Treasury bond is generally where people go for safety, right?
That's generally what the industry prescribes as the prescription. If you don't want to take on too much risk with equities, then you reduce your risk by taking on more bonds.
Yeah, I guess that's not a recommendation by any means, but that's just a traditional way that people go. But minus 1.45%.
Yeah, and
And
we had some uptick at the end. We saw the longer term treasuries start to the yields on those start to fall a little bit, and that's where you see those green candles there. But that's a very choppy chart there. Jesse didn't describe this, but the red candles are usually selling days. The green candles are usually buying days, and so it's much more positive. But you can see there's a lot of movement on here, and we saw the 10-year Treasury yield jump up to as high as 3.5%. And Jesse, I'd be curious to see where it ended up yesterday in just a minute if you have a chance to pull it up. But it's something that folks think that if they own that 60-40 portfolio, which is 60% stocks, 40% bonds, which is kind of the typical mantra that your typical financial advisor is giving to his typical client. Now, every one of you is unique that's listening today, but you want to make sure that the portfolio that you own is in line with what your risk objectives are and your long-term investment goals. Because that 60-40 portfolio has been getting beat up quite a bit this year. And one of the things that people may not know, and we're technical analysts and active risk managers, and we don't own a typical 60-40 portfolio for the clients that are in retirement. We're active managers. And so when things get a little bit squirrely in the market, you can shift the assets around to where they need to go. Now, in the last month or so, has been very squirrely, and we've had to position a number of our clients in cash that were part of our active management program, but that will change. And the objective there is to try to protect those assets. But a lot of people think that in normal times, bonds are a lower risk asset to go into. But as Jesse's showing here, that from peak to trough, that long-term Treasury bond index was down almost 30%. And I still think it's in the, even after interest rates started dropping later this month in June, I still think that's still a plus 25% or minus 25%. Jesse, is that about right?
yeah, it is. And I just think it's interesting that it peaked around December 6th, whereas the Nasdaq peaked in November and the S&P peaked in January. This index that we follow peaked in December, and it's really been wavering since through June 16th, which is the same date that we talked about for the other indexes.
Yeah, and that's right around that was the week after the Federal Reserve raised interest rates 3/4 of a point. We'll talk about that later in the presentation. But
Right.
bonds have not been a safe place to hide during this bear market. This bear market's been somewhat similar to the bear market we saw in 07 through 09, but there's some characteristics about this one that we haven't seen before, and we'll talk about that in just a moment. But basically, I think what Jesse's trying to sum up is unless you're working with an advisor that's actively managing your portfolio, there really hasn't been a whole lot of places to hide. So when you see returns of the S&P 500 down 24% through mid-June, I think it's still plus 20% through the end of June, slightly better in the last week, but still a lot of long-term
Yeah.
damage has been done to the typical buy and hold investor that's just been sitting around holding that portfolio. So
Yeah.
Jesse, this is a little bit dated here. We should have updated that, but this is through May.
Oh, you
Uh,
know what? It actually is through June. I just forgot to move the title around.
oh, okay, all right.
That being said, I just wanted to give everybody listening kind of a picture of the S&P 500 is, like I said, the largest 500 companies in America. It's an index that we follow every day. And this has been the performance over the last 2 years. Early on there in 2020, you can see the pandemic when everybody received news of what's going to happen to the world. We had a lot of different issues that came up, but and then we had this run up in 2020 and 2021. And as we've been covering so far this year, we are seeing decline with a handful of bear market rallies. So this is an overall chart pattern. I think it's always good to have a multi-year perspective over what's happening. But do you have any
Yeah,
comments on this?
we had the pandemic drop off here, And the thing I think people forget about is this was an artificially created recession because we shut everything down. The government shut everything down, and the stock market didn't know what to do with that. Never been done before. And so that's when you had declines there of around 35% in the S&P, and that created a lot of carnage. But we've had this growing since then. Now, up here at the top, the very top of the chart here, this was January 4th. And
Right.
Jesse, is this a weekly chart or a daily chart? I don't, it's
It's a
probably a
weekly
weekly.
chart.
Yeah, it's a weekly chart. And you saw this to roll over, and there's certain resistance points in here that we're looking at. The first one was back in the early fall. We were looking at October time frame. Let me get a different tool over here so I can draw on this. Let me do the pen here. Let's see if that'll work.
Yeah, the pen or the highlighter would work great.
Okay, here we go. So we had, some early resistance that goes back to the fall, and it's not drawing for me very well. Let me use that highlighter. That'll probably work. Sorry, folks. I just want to be able to illustrate something for you. And do this and see if I can make it work. May not want to draw for me today. We had some support right in here. That's not working, Jesse. Okay, I'm going to use the laser pointer. People can watch my little laser pointer. We had support right here that were the lows in October. So we had a little bit of a pullback in October of last year, and then that collapsed. And in January, we had a little bit of a rally in February, and then that collapsed, and it collapsed through levels back from really the third quarter of last year. And
So
then
these
that
are,
had
these
a
are
little bit of
horizontal
rally.
lines that you're talking about, right?
What's that?
These are horizontal lines.
Yeah, I'm drawing with my laser horizontal lines. These are areas of support from a technical perspective. We had a little bit of a rally. Then we pulled back. We broke through the lows back through in March of 2021. And then we had a big rally in really the March timeframe. And that's when the talking heads on television started saying, oh, the bear market's over. Everybody jump back in, both feet. And, I think it's a situation where you don't really see these trends continue when it's a true bear market and we've got a lot of resistance. I mean, they've got so many things that are really working against us here with that. Jesse, can you see my chart? Because it's not, I'm getting some feedback that people aren't able to see that chart. We'll
I'm
see.
able to see it.
You're able to see it? Okay. Sorry about that. Well, we'll be sending out a recording of this so that you can listen to it again, and maybe that'll show better there. Let's go over here and let's get into the economic update. Jesse, did you have anything else you wanted to add here?
No, I just think that it's great to have a perspective of what's been going on throughout the year because we show you these little segments of 1 month trading, but there's a greater picture here. But yeah, I'm going to pass it back over to Mark so he can talk about the status of the economy. Do you think we have smooth landing or turbulence ahead? Mark, you can put on your economist hat now and give us some macro updates.
If I had my camera on, you would all see that my beanie hat with the propeller on top. So we're going to get into a little bit of the background. There's really 3 or 4 major things that are potential red flags for ahead, and we've been talking about some of those all the time in the last several months, and on our radio show, which, by the way, if you like to listen to that, you can go to our website, spendlifewell.com, and find recordings of those shows with a link to our YouTube page, etc. So that has been very interesting, and I tend to listen to a number of different economists because I want to get differing perspectives. And right now, the interesting thing that I am seeing is that no one can agree on which way the economy is going. And so the information that I share with you today is just my professional opinion. And that's when you turn on the television, that's all it is as well. It's their professional opinion. I was listening to two very well-known economists yesterday, and they both disagreed about what's really happening in the economy. So my view on this is that we are more than likely going to go into a mild recession here. We should see that information come out in the next couple of weeks as to whether or not what was the economic growth for the second quarter. And I've got a slide here in a minute I'll share with you on that. But a lot of different factors here. We've got inflation, we've got rising interest rates, because the Federal Reserve, the only tool that they have available to them right now is to raise overnight Fed funds rates. They are still have not really begun to unwind the balance sheet of the hundreds of billions. Actually, it's over $1 trillion, right? Over $1 trillion, over $1 trillion of bond buying that the Federal Reserve has done over the last 2 years to try to prop up the economy. And so we've got that going on. That's going to cause some problems for the markets and bond market especially. And then we've also got the potential of slowing down of the economy.
So that relates back to both of the, or several of the indexes that we looked at the beginning of the show, or the presentation here.
Absolutely.
The Treasury bond index is heavily reliant on the interest rate environment, and of course the stocks are as well.
Yeah. Did you ever find that what the 10-year Treasury closed at yesterday?
Oh yeah, let me check that while we.
Okay. All right. I'll go on the next slide here. So got these three factors, and how's that impact? How are rising interest rates really impacting the economy? Well, this was an article from the Wall Street Journal just yesterday. Housing affordability drops to the lowest level since 2006. Now, if anybody was around in 2006, you may remember there was something going on about a housing bubble, and it was just about to pop because lending was easy, borrowing was easy. And so this is a pretty significant thing here. The Housing Affordability Index, and this is something that's put on by a division of the National Association of Realtors. I did my master's thesis on housing affordability, so I know a little bit about this, and I thought it was interesting. This is where the average household, it's an index that determines what's the amount of house or mortgage that an average household in a certain market can afford. And it's been dropping. It's been dropping the last several months. It fell to 102.5 in May. The index, last time it was that low was around July 2006. And so we're seeing that households are not able to afford as much house as they once were were able to do at the beginning of the year.
Yeah, Mark, on the radio show, for our people joining us today, if you listen to our show, we by no means did an academic research, but we did a kind of a live interactive research where we talked about the average home price in Texas compared to the average income in Texas. So that was an interesting discussion.
Yeah, and I think that our example there, because of rising interest rates, and we've actually seen mortgage rates this week drop just a little bit, but that remains to be seen if they continue to go up. So we get an example that an average price in Central Texas might be $300,000, and an average household income might be $60,000, $65,000, $70,000 a year. And what once was a $1,200 a month mortgage for the same house is now, because of rising interest rates, over $1,800 a month. And when lenders are looking to determine whether a borrower can afford the monthly mortgage payment, they're looking at the cost and other debts that that household has. And our little calculation, our little exercise that we did was not, including folks that maybe had a car loan and student loan debt or credit card debt. All those things add up. So what we're seeing here, and this is what the article was about in the Wall Street Journal, was that houses are becoming less and less affordable, and we're not seeing the prices of houses drop yet. What we are seeing is A number of realtors have reported to us that houses are staying on the market just a little bit longer. Houses are staying on the market just a little bit longer than normal. I spoke to someone that was selling their house, and a few months earlier, their house would have sold before they even had it listed. I'm exaggerating here, but it would have contracts on it within the first day. And it took them over about a week to get contracts on that house. And that's just kind of an example of things are cooling off a little bit. If you've been thinking about selling your home, you want to talk to a professional realtor about the timing of that. We're getting to the end of the summer buying season, so you want to think about that. But we're seeing that fewer households are able to afford the average price house, and so that's a sign of the cooling economy. And if that happens, will new construction start to wane off? I don't know. We haven't seen that yet. Housing starts in May grew about 14% year over year. That's a good sign. And what we're seeing is a lot of mixed messages with the economy right now, a lot of mixed messages. A lot of people are asking us, are we in a recession? And, the US economy has experienced 12 recessions since World War II. And each one of them included two distinct features, all right? And this is in the article in the Wall Street Journal from earlier in the week. Economic output contracted. In other words, gross domestic product contracted, okay? We saw in the first quarter that GDP, gross domestic product, was minus 1.6%. Now that keeps getting revised down, but it was minus 1.6%. So we got some economic contraction, but it's not really we're not seeing the same thing when it comes to employment. And unemployment stayed at 3.6% nationally. That data was released yesterday from the Bureau of Labor Statistics. And so we're not seeing both components, an economic impact output that contracts, and we're not seeing the unemployment go up. And so that's kind of unusual, right? Where it's unusual when you start seeing economic output fall, but the job market showing little signs of faltering the first half of the year. So this is kind of strange because a textbook definition of a recession is 2 consecutive quarters of negative economic output or economic growth, okay? Mm-hmm. And it's, you can turn on the television or listen to the talking pundits on TV, and there are so many people that are in disagreement about this. And I think that from a textbook definition that we probably are going to be here that we're in a recession, but it's going to be one in which unemployment is not going to go up very fast because the demand for employees is still out there. I mean, we can't drive down the street anywhere where you live and not see help wanted signs. And it's something that's a little bit unusual. It's a kind of a strange twist to this, but there's a number of analysts out there have been talking about jobless recoveries after past recessions. So it's interesting to see if this will be a typical recession or not. But one of the things that's been changing, because we've seen that another sign that the economy is cooling is we've seen inflation go up over 8.6%. I suspect that when they release data here in a week or so, we're still going to see that inflation is still above 8%. That's probably going to continue on through the fall or the summer, really, and then you'll start seeing it tick back a little bit. But inflation's inflation. But one of the things we're not seeing, although wages have risen for the average worker over the last 12 months, they have not risen as fast as inflation. And that's real important, Jesse, because if workers and families are not able to make enough money to pay their bills and the rising cost of goods and services, what do? They slow down. They start substituting things. This is the classic economics example you had in your economics class in high school or college. You start having substitution of goods. You know, instead of going to Starbucks, you may start buying some Folgers and making it at home. And all those different things like that, because we all know gas prices are still high. Although I did fill up my tank this week for $3.99. Later in the week, it was up above 4 again. But you're seeing all this inflation begin to eat into our personal savings. And that's going to start, people are going to start slowing down their purchases and things. So this is, if we are in a recession, we haven't been told that we are, it's going to be a unique type of recession that really may be a jobless, not a jobless, but we're not going to see the unemployment rise as we have seen in past recessions. In fact, Jesse, I think that we're going to see a kind of a redefining of what's a recession,
Okay.
because our administration in Washington has got nothing but bad news, and I would not be surprised if they tinkered with the definition of what's a recession. And so don't be surprised if you see that in the coming weeks. You may hear of a recession, but I bet the government's going to come out and say, oh, this is not a recession. But here's an interesting thing here. This is a data from the Atlanta Federal Reserve, and they track and make their forecast of estimates of gross domestic product, that GDP or economic growth. And what's been interesting, and this chart here is showing how the GDP estimates from the Atlanta Fed has been falling since May. And we went from, what's that?
It's choppy too. I mean, they've been changing this chart on a daily basis. I had to go in and get a new screenshot because they keep changing it.
Right. And so, you know, this particular chart, 2 weeks ago, after the Fed met to talk about interest rate hikes and stuff like that, 3 weeks ago, they said that the economic forecast for the second quarter was going to be, you know, around, plus positive 1.6%. Okay. And then they revised that down to 0.9. And then a week later, they revised it down to 0. And then last week, towards the end of the week, they revised it down to a negative 1.9% contraction. And you can see this week, Jesse, they increased that forecast, although still negative for the second quarter, showing it to be a minus 1% economic growth. Now, we won't know. We'll know here in about a week or so what the actual GDP numbers are for that. But I think that this is really telling that, yes, the economy is slowing down. Now, what does that mean for stock markets? Well, it means a lot. You've got several factors that are going on there. We mentioned earlier that the tech stocks really don't like a rising interest rate environment. Well, based on the employment data that we saw yesterday, it's our view that the Federal Reserve is going to raise interest rates here at the end of July, probably another 0.75%. They probably will raise them again in September. And beyond that, nobody knows, because the Federal Reserve is behind the curve. They should have started raising interest rates last summer, if not last spring, and they didn't do it because they know that when they raise interest rates, it impacts the stock market. And this is something people don't realize, but for over the last decade, the Federal Reserve has been there to prop up the stock market. The Federal Reserve has been there to prop up the stock market. And it's like, what, Mark? Wait. How can they do that? Well, every time, and we got some charts, we didn't include them today, but every time that we have seen the stock market throw a tantrum because they wanted to change different quantitative easing type programs with the Federal Reserve, they stepped in and said, no, we're not going to do that. We're not going to raise interest rates, things like that. And you see a rally. And so the Federal Reserve's action towards interest rates is in part a reason that the stock market did well in the last 15 years. Okay. So they're not be able to do that this time. And they know that. The Fed put, as we often call it, is not going to be available there for investors. And so that's not a looming challenge, but it's something we just have to watch for. And we may not see the rapid recoveries that we've seen in the past bear markets. So That's one thing. Then you've also got rising inflation, which is basically causing the cost of goods and services to go up. Well, guess what? Corporations cannot just eat those losses. They have to pass them on to us, the consumer. Despite what's coming from Washington, Jesse, I think I shared this with you, but we saw a tweet on Twitter from the White House last week that was basically begging gas station owners to lower the price of gasoline. And it was clear that whatever intern was tweeting that out over the weekend did not understand economics. And I think another number of people tweeted back and said, no, that's not how it works. And that you might want to enroll that intern in Econ 101 in the fall. But I don't know who's in charge in Washington. It's not giving me a lot of confidence about this, but I'm not going to worry about it because with us as active risk managers and technical analysts, we're going to respond to the data that we have. And so we're going to invest where it's appropriate or not invest when the market is particularly weak. So this chart that's on the screen right now is just showing historical performances of the S&P. Now this goes through May, and Jesse updated you that we're at the end of June, we were still minus 20+%. Right. But you can see how in past bear markets or whatever, you can see how the S&P responded in the second half of the year. Now, I'll give you my best financial commercial disclaimer, and that is past performances are not indicative of future results. But this just gives you some type of pattern here that you can maybe study and look at. But we don't know where the market's going to go, which is exactly why we use technical analysis and active risk management. So
yeah, there's a slide that we sometimes provide in this, and it says that we're not in the prediction business, right? We're in the interpretation business.
That's right. And no one can predict. No one can time the market. No one knows where the market's going to go. Despite all the talking heads you see on TV, they don't know either. And so one of the things that we typically are looking at every day, and we don't have a chart on that this particular month, but we're looking at all the sectors in the economy. And we're trying to see them, are any of them underperforming just holding cash? And I think some healthcare and biotech might be, Jesse. I haven't looked since yesterday, but well, that's about it.
And they actually trailed off towards the end of the day as the market closed yesterday. And we closed out the week with cash being the top leader.
So cash has gone back to the top.
Yep.
Okay, folks, so what that means is that there is not any particular asset on a monthly basis that is outperforming just holding cash. Now, there's a couple of subsectors of that are outperforming. Those are things that we will invest in if necessary, but we're going to be very cautious in this environment. Here's that bear market rally chart I wanted to show you, because I put up here that looking at 2000, 2002 bear market and the 2008 to 2009 bear market. If you go back to 2002, there were actually 6 bear market rallies before that bear market was over. Okay, and this is where the market declines and then there's a rally, and then it declines again. So we see here in some of those rallies were 21% or more off the bottom, and only to roll over again. In the 2008 and 2009 financial crisis, we saw 5 of those. So if you see the market, bouncing up, be careful. Don't be thinking that it's time to jump back in, and certainly don't listen to the talking heads. What we've recommended, if you are a buy and hold investor, if you got a 401k, that's just simply to keep investing because you're buying at cheaper prices, right? The prices are down. You're buying into your systematically, your dollar cost averaging into your 401k or IRA. Don't change those. We had a question on the radio the other day. Someone called in and wanted to know, should they just stop because they tend to be losing money. I said, well, your first inclination might be to do that, but if you're dollar cost averaging like that in a 401k or workplace retirement plan, now's the time to keep buying in. Don't increase your contributions necessarily. You want to talk to a financial advisor before you do that, but the fact that you're buying at cheaper prices is going to help you in the long run, especially if you've got a long-term investment horizon. So what we've really been looking at is don't let this market bounce, if there is one, don't let it blind you into the underlying fundamental fiscal and monetary and economic conditions. Rising and falling markets are always accompanied by periods of counter trend movement. So we'll see a little bit of a rise. Now we've actually, Jesse, I think the S&P probably ended up for the week just a little bit, but it's still been moving in a sideways motion.
Yeah.
Sideways, that consolidation type stuff that we've seen before. And I think the market's waiting for data. Market's waiting for data to see which way the economy is going to go. Everyone's trying to predict. It's like everyone's got a crystal ball and they want to try to predict what's going to happen next. And the reality is, folks, we don't know. All we can do is respond to the data that we're given. And when we do that with our clients, we're going to reallocate portfolios appropriately to try to make money and protect money at the same time. So if you've got questions, if you're a client and we haven't chatted in a little while, give us a call. Will be a little short survey at the end of this. You can request an appointment, but give us a call. You can call us at let me put up our stuff here, 800-491-4508. Or if you just want to call and get an appointment, you certainly can do that at that calendly.com. That's www.calendly.com/Mark Trice. But as always, we say go to the website. You can request appointments there.
Right.
I see a number of clients that are on the call today for this. Jesse, I don't know, was there any additional slides I need to go into on this? Because I see there's more, but I don't want to go through those if I'm not supposed to.
No, well, that's just if you wanted to keep going, but that's up to you. I think it's important to those of us joining, for those joining and for those that are clients and not clients, that's probably the most popular question that we've gotten over the past, half of the year basically, is that question that Mark covered a few minutes ago. Should I stop contributing to my retirement? And as Mark said, the answer is probably no, don't stop. But your situation is going to be unique. And if we have not spoken about it outside of the webinar environment, then just give us a call, reach out. The phone number is right there. If you want to send us an email, we're happy to talk about those things with you.
Yeah, just give us a call. We want to thank you for joining us. There will be a recording of this. We will send that out to all our clients in the coming week once it's approved, and you can listen to this again. But folks, if you have questions at all, please, give us a call. We'll be happy to visit with you. A lot of times now we're just basically taking calls. People are just concerned. They want to make sure they're going to be okay. And the answer is, yeah, you don't need to worry about those things. Let us worry about managing the money. You worry about working, retirement, and so forth. But that's why we love working with our clients, because we love helping them through difficult situations when they pop up. So to wrap up, I'll just say that, okay, there's a lot of uncertainty in the economy, a lot of uncertainty in the market, but these things too shall pass, and we will continue forward, and we'll keep working every day and waking up and putting on our pants the same way every day and keep moving forward. So thank you for attending. I want to thank you for that. Like I said, we'll send out a recording a little bit later next week, and you can listen to this again, but please don't hesitate to give us a call in our office at any time, 800-491-4508. So let me see if there's any questions real fast before I jump off. And looks like the board is clear. Thank you for all attending, and we will talk to you next month. Jesse, I don't have my calendar in front of me, but it'll be the first Saturday of the month, 9/15, and I think that might be
August 6th.
August 6th. All right. Next time for a market update, August 6th at 9:15 a.m. If you can't attend, just register. We'll send you the recording a little bit later on. But we appreciate your participation today. Have a